Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in TradFi, digital assets, technology, and financial planning. I'm your host, Jill Malandrino, and joining me at the desk at the Nasdaq market site, we have Kevin Mahn, Chief Investment Officer of Hennion and Walsh, Lydia Boussour, Senior Economist at EY-Parthenon, and Brad Neuman, Director of Market Strategy at Alger. We're here to discuss what's driving the macroeconomic narrative and areas outside of tech that investors could consider for an investment. It is great to see you guys, as always. Welcome back to Trade Talks. Kevin, two guesses. What's the 2024 theme been? AI and the Fed.
AI and the Fed, without a doubt. And it does seem like AI has been the tail wagging the stock market dog, if you will. But if we think back to 2023, the Magnificent Seven stocks, right? They accounted for over 62% of the total return of the S&P 500 last year. This year, it's down to below 40%. So still, they're leading the way, but to a much lesser extent. And that expansion of the rally, Jill, as you know, is my overall macro theme for 2024. I do think, however, that the market's got a little bit ahead of itself thus far this year, considering that I believe the market has priced in the perfect execution of a soft landing by the Federal Reserve. And we're not there just yet. And if you think back to the mid-1970s, the last time the Federal Reserve started cutting interest rates prior to getting inflation back to 2%, what happened? Inflation came roaring back, hit double-digit levels, and then Paul Volcker had to step in, raise interest rates to a 20%. Imagine a Fed funds target rate at 20%. We think 5.25% is restrictive. He stamped out inflation, but he brought on a recession. That's what the Fed is navigating right now. They're really trying to thread the needle.
Yeah, well, I mean, if you think about it in terms of pricing for perfection, according to Comerica, their note this morning, the other 493 stocks within the S&P 500 climbed 8%. Yeah. We're just in, well, now in Q2, but that was just the first quarter's returns. Lydia, do you think the economy is over-accelerating, or do you think we'll start to see some growth but slowing at this point?
Yeah, I think we remain on a soft landing path for now. The economy is still showing resilience. We're seeing encouraging economic dynamics, resilience from the consumer, resilience from the labor market. And there has been a lot of shifting narrative at the beginning of the year because of some bumpiness in the data. We saw a lot of noisiness in the inflation data, stronger than expected inflation data, and that has led to some shifting narrative and some people expecting the economy to reaccelerate and inflation to reaccelerate. Our view is that we're not in this environment. The economy continues to cool. When we look at the labor market, we continue to see some signs of softening in labor market conditions and some rebalancing happening. And we think that the economy will remain on that gentle deceleration, and that growth is going to be around 2% this year, and that inflation is going to continue to cool as well. So we do think that we remain in a disinflationary environment overall.
Yeah, I mean, Brad, the question is, I mean, how much more can the consumer hold up? I mean, there's been quite the path of momentum there.
Yeah, I was going to say on the one hand, you know, you have the leading economic indicators ticking up for the first time in 22 months, and you have cyclical areas like housing and manufacturing picking their head up and getting out of their slumps. But the consumer, the excess savings may be running dry. You know, there was arguably $2 trillion of excess savings from big fiscal stimulus during the pandemic era. That, by our calculations, is running quite low. And the labor market, depending on whether you look at the household survey or the establishment survey, shows kind of two different pictures, and arguably the employment picture is softening a little bit. So I would expect consumer spending to weaken a little bit here, and we've seen some of that from some company-specific announcements.
Yeah, well, it's interesting that you had mentioned savings, and I wonder if part of that has been propped up. We were talking about the housing market off camera before. There's just no supply, right? So what are people doing with their money that want a home? They're saving, and they're saving to the point where they're coming in with full cash offers. I mean, I wonder if the housing market is reflective of the balances that still remain in savings accounts. I mean, that's just conjecture, but I mean, the housing market's a big piece of this too.
It really is, and if you think about it, housing or real estate is generally the largest asset on most individual investors' balance sheets. So as real estate prices go up, they feel better about themselves, right? And they start to spend more. As housing prices come down, they feel less optimistic and they spend less. That's important because consumer spending accounts for 70% of economic growth in our country. So I just wonder how much longer the consumer is going to feel comfortable spending, not only with mortgage rates near 7%, but also with $1.2 trillion in outstanding credit card debt, and also at these very high elevated levels that they're going to have to service that credit card debt. If in fact they shift to servicing their debt as opposed to spending, the economy has to slow, and the Fed will ultimately have to step in to prevent that economic slowdown from potentially becoming a recession.
Right. And we were talking about the market being priced for perfection, Lydia. I mean, it seems as if investors aren't even concerned that they were pricing in 6 rate cuts. We might get 3 this year. So we know, what's the market moving on? Is it fundamentals? Or, I mean, you know, we're kind of always thinking about that once we're in this earnings vacuum and everything gets focused back on the macro.
Yeah, so I think, you know, if you look at right now, the latest economic data we're getting, there's a lot of noise in the data, and we know that the Fed is data dependent, so everybody is really scrutinizing every single data point, trying to assess what that means for the Fed and for the economic outlook. I think what we tell our clients and what we think is very important is to also take a step back from this single data point and really think about the broader economic outlook, the broader inflation outlook. We saw these data prints in January and February, which were partly reflecting of some noise we typically get at the start of the year. So I think, you know, as we move ahead, we really need to start seeing more softening in inflation data, and that's going to be, I think, the key focus. But right now, I do think that there is too much focus on every single data point. We saw that with the ISM manufacturing kept coming out, you know, stronger than expected. So there is a lot of volatility right now, I think, in both market expectations, but also the narrative that we're seeing out there.
Yeah.
I just want to make one point on the stock market. You know, we're talking about the 7 and the 493, and obviously all that's the S&P 500, and obviously sentiment is elevated, whether you look at, you know, equity fund flows, low VIX, you know, overall valuations. But, you know, at Alger, we're stock pickers, and so we can, you know, invest in any stock, be it in the S&P 500 or not. And when you look at small caps, you know, they're only up 2% on the year. They're 20% off their highs. So I think there's a little less sentiment baked in there, and actually from a valuation standpoint, they're the cheapest they've been relative to the broader market in about a quarter of a century. The fundamentals are supposed to grow kind of 2x the broader market over the next few years, and they have a very high negative correlation to interest rates. So if interest rates do come down, I think we ultimately think, all of us probably at this table, they'll ultimately come down. That should be good for smaller cap stocks to outperform. Yeah,
I mean, certainly cost of capital is an issue when it comes to the balance sheet, which is probably why there, you know, you see the disparity in terms of returns.
We talked a lot about this idea of cost fatigue when it comes to businesses, but also consumers, and the fact that, you know, when you look at the cost of pretty much everything, it's much higher than it was pre-pandemic. And when you think about the consumer, yes, you know, inflation has come back down significantly, but there is also this idea of inflation perception and the fact that consumers are still seeing that high level of prices, and we are still in this tight monetary policy environment that's still putting downward pressure on private sector activity and still leading to more caution, we think, in both consumer spending, but also in investment decisions from businesses.
Yeah. I mean, is it necessarily inflation, Kevin, or companies that have perhaps taken advantage of the inflation narrative and they're thinking about their margins before they're thinking about the consumer? I mean, the supply chains come back in line.
I think it's a mix of each, and we're optimistic about the outlook for small caps as well. We see 2 specific tailwinds there. One, valuations, 2, the outlook for lower interest rates. Within the small cap space, we really like biotech and also other transformative technologies beyond the big chip makers that dominate the large cap space and much of the narrative in the media. But I do think there's other opportunities just beyond AI. And if you look beyond the chips and the semiconductors, the way I view the AI ecosystem is there's enablers and there's drivers. The enablers are the semiconductors, the chip makers, and also the data centers. But how about the drivers of AI, the hardware and the software companies? And then what gets lost in this whole conversation is cybersecurity, which I always refer to as the glue that holds the technology puzzle together. AI can be used for good, and AI can be used for nefarious reasons. And what we're seeing more and more now is AI being used to create more and more effective cyber attacks. So we're going to need AI-infused cybersecurity to help thwart AI-powered cyber attack. That's a good investment opportunity as well.
Yeah, it certainly is. Let's talk about the election cycle for a moment, Brad. Do you think that volatility is showing up in the market anywhere?
Well, we haven't seen a whole lot of volatility yet. Typically in an election cycle, you have the stock market trade off on kind of uncertainty into the election and then rally or do better on the resolution of the election and more certainty. So I would advise investors to be prepared for some kind of volatility heading into the election. But in general, you know, we think the election is a bit of a distraction. You know, if you went back and you tried to invest based on policies, it's it's pretty difficult. So 2016 election, if you invested on kind of America First type policies and lower corporate tax rates, those domestically oriented companies actually didn't do that well in the 1 to 2 years following the election. Same thing after the 2020 election. If you had invested in companies that would benefit from kind of environmentally friendly policies, they didn't do that well over the next couple of years. So what has done well in both those cycles is more innovative, fundamentally growing companies, so that's what we stay focused on.
Yeah, well, it's so interesting. I believe that was the year New York Times had like fantastic returns, right? As compared to something like U.S. Steel, where you would think it would be the inverse of that. And I believe that was the case. So it sounds as if, regardless of the election cycle, the stocks that are in the innovation lane are going to perform regardless of who's in or who's out.
Without a doubt.
Yeah.
And I think one of the areas you find innovation is not just in technology, but in healthcare as well. There are many rare chronic diseases that we still don't have treatments, less such cures for. And where do those treatments and cures come from? Generally smaller cap biotech companies. And it's fascinating to see some of the innovation that's taking place there, whether it's with respect to oncology, immunotherapies, CAR T technology, CRISPR, gene editing, gene splicing. Fascinating what they're actually working on right now. And the investment opportunity comes from the likelihood that large cap pharma is going to use all their excess cash that they have on their balance sheet to acquire these innovative healthcare solutions from the small cap biotech companies. And we've seen a pickup in that M&A activity. So I would expect to see smaller cap biotech M&A activity only increase and provide even more investment opportunities for investors to consider.
Right, well, that's been the trend within, the mega cap space as well, where they're acquiring these smaller, more nimble companies and then able to bring them in versus having to grow organic, and then they're able to take that to scale. I mean, certainly seeing that in fintech, we're seeing it in, what you would expect at a large mega cap. But going back to the healthcare theme, we're living longer too, right? So there's just so many different themes with that when you think about the generational wealth transfer. Now you're thinking about the advisory space, and then you're thinking about people living longer. It feels like it's all coming back to what's happening from a generational perspective. I realize it's a little bit abstract, but there's a lot of sector moves.
Yeah, it's good and bad that we're living longer. A, we need a bigger nest egg that we need to plan for better to be able to draw down on that nest egg and ensure that it lasts our full lifetime. And B, we need better drugs and better health care to allow us to sustain our lifestyle throughout that extended longevity. So I think that creates investment opportunities clearly, but for investors, they really have to develop a sound financial plan accounting for how much longer they're expected to live and make sure that they have a nest egg sufficient to last their lifetime.
Lydia, where do you see opportunity outside of AI tech?
I mean, we're talking about healthcare, and I think it's interesting to see that looking at the jobs number, for example, we're seeing a lot of resilience in the healthcare data. And healthcare employment has been quite strong despite the slowdown we've seen in the softening we've seen in employment growth. So that really makes me think about some of those pockets of strength we've seen in the labor market. We're going to get the jobs report on Friday.
Yep.
I do think that healthcare and government have been two key sectors that have continued to drive job growth.
Yes.
And that's a trend that's likely to continue going forward. And one of the reasons why we haven't seen that slowdown in healthcare employment.
Yes.
So it sounds as if the theme is stay invested despite that the elections are coming up. And of course, the market's always climbing some wall of worry. We know geopolitics are certainly heightened. So sounds like stay invested, stay in equities. Anything on the fixed income side?
We like municipal bonds, investment grade municipal bonds in this environment, particularly municipal bond closed-end funds that are leveraged municipal bond closed-end fund benefit from lower interest rates. That's what we anticipate over the next 3 to 4 years if in fact the Fed's dot plot holds true. I still find it fascinating. I wonder what everyone would think, though. The Fed is currently forecasting 75 basis points of cuts this year, 75 basis points of cuts next year, and yet another 75 basis points of cuts in 2026, without inflation coming down to 2% until the end of 2026. So are they really that concerned with their 2% inflation target? Or are they more concerned with the economy potentially slowing down too far and moving into a recessionary period?
Right. I think coming out of the Fed meeting and looking at the dot plot, I think it was also interesting to notice that and maybe a signal that the Fed is willing to be a little bit more patient to get back to that 2% target.
It seems that
Fed Chair Powell said he's strongly committed, and they are still strongly committed. We heard it today. They don't want to do the same. They don't want to make the same mistake as in the past.
Yes.
But at the same time, they also don't want to risk, a deeper downturn than the economy would be, a deeper economic downturn. Essentially, we still have resilient economic growth. We still have resilient labor market trends, And we also have this revival in productivity growth, which I think has been a game changer. The fact that the supply side of the economy has been responding and has allowed for that non-inflationary growth. So I think a key question, as we head into the second half of the year, are we going to see that step down in inflation from this noisiness in the first quarter of the year? Core PC inflation was running at around 2% on an annualized base in the second half of last year. We came back up to around 3% in the first quarter. Now we need to come back down towards 2% so that the Fed is going to be confident enough to start that easing cycle. And we think that by the middle of the year, core PC inflation could be around 2.5%, and that's going to create the confidence and the room for the Fed to start that easing cycle. But it's not going to be the typical easing cycle. It's going to be very gradual.
I think the Fed's comfortable with 2.5%. They're not going to say that publicly, but I think they're comfortable with 2.5%.
I mean, I wonder if the market is interpreting it that if we don't get rate cuts, it means the economy is doing well, which is a good thing, right? So it kind of signals when you have to make a rate cut that there's, a little bit of uneasiness in the system, and perhaps they're looking at it glass half full because the economy is strong. People are working and the consumer's contributing to the economy, because we got that move in December when everyone thought we were going to get the 6 to 7 rate cuts, and we hit all-time highs last week with maybe 3. Maybe. So, I mean, what are your thoughts, Brad? Economy half glass full is better than a rate cut?
Economy glass half full is better than a rate cut. I think that right now the market moved into bad news is good news. For us, we take a longer term view. I mean, 5.5% is probably an interest rate that's too high, so that's coming down. But we see a lot of companies that can grow whether rates are 5.5% or 3.5%. So like you're talking about innovation. There are areas of innovation outside of we love technology and we love healthcare, but there are areas of innovation outside of that, like alternative asset managers, for example. You don't think of that as an innovative category, but mass affluent people in America have like 3% of their assets allocated to private wealth. Private assets. That compares to institutions at like 10 times that. So there's a big area for growth. And the innovation that's happening here from companies like Hamilton Lane and StepStone is they're lowering the liquidity minimum. They're increasing the liquidity for individuals, and they're lowering the minimums that individuals need to put up to get into these asset classes. And so we think that that's a big growth area, and that's kind of an area of innovation that we think can grow, regardless of really where interest rates bounce around.
Yeah, well, actually, we've been covering it more frequently as well as, the ultra high net worth or retail investor can get involved in the space as well. And you're starting to see companies custody more of these assets as well, which of course, if there's a product and there's demand out there, they certainly will grow the product in the space, that's for sure. All right, I appreciate everyone's insight. Thanks for joining us on Trade Talks.
Thank you, Jill.
And thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.